Hello and welcome to Money News on Newsmax TV. I'm John Bachman. Joining me right now via Skype from New York City is David McAlvany. He's the CEO of the McAlvany Financial Companies. And David, it's always great to have you back with us.
John, good to be back with you.
All right, right now we're going to talk about the downward pressures on the price of oil and gas and a potential bubble in the asset markets. Now, after plummeting to the lowest levels in nearly 3 years, gasoline prices may be close to hitting a 2013 low on average of about $3.20, but that's probably about as low as they'll go this year, some experts are saying. Rising wholesale and crude oil prices may have dashed hopes that retail gas prices could dip below $3 nationally for the first time since 2010. Do you agree with that assessment?
Yeah, and unleaded gasoline seasonally does trade off through about the middle of December, and then you begin to see a pickup in price from that point forward. And part of that is because you've got refineries that are changing over and winterizing and getting ready for sort of the different demand, different product that's being used. So unleaded gasoline does have some fluctuation based on some of those seasonal patterns. Oil, of course, is moving for very different reasons. Certainly some fear premium coming out of the market, and the oil market is very well supplied right now, with Saudi Arabia bringing to market more oil than they have in a long, long time.
Yeah, so there are more factors here, I think people would say, than just the annual up and down, the ebb and flow of the gasoline prices. But where do you think these prices could go based on some of the information you just told us looking ahead at 2014?
Well, I think, again, you've got softness probably for another couple of weeks in terms of unleaded gasoline, and then it probably picks up from there. It's anyone's guess as to what happens with the negotiations with Iran, and again, whether or not there's fear premium that comes out of the market on that basis. So we've been trending down, and it's not unreasonable to think that we could see oil prices lower by $5 to $7. That would take us to about 100 on Brent and probably 85 on West Texas. And then once we reach those levels, trending higher again by the same amount that we've given up, but adding anywhere from 7 to 12%.
Talk about a little bit more some of the specifics with the Iranian sanctions in just a second, but let's focus back on production. You mentioned Saudi Arabia. U.S. oil production, too, has been soaring. In October, the U.S. pumped more oil than it imported for the first time in about 20 years, I think. Meanwhile, the American Petroleum Institute is considering a push to change a law that dates back to the 1970s that restricts the amount of oil that can be exported out of this country. The Institute claims that law violates the country's free trade agreements. If that does happen, how do you think that will impact the overall economy here and abroad?
Well, certainly there is a bullish factor for the U.S. economy if you're looking at our energy picture on a longer-term basis. Some of what we still have to prove out for that to be the case is the decline rates with the wells that are currently being pumped. We don't know how steep the decline rates will be. But at present, we certainly have quite a bit of oil coming out of the ground. And, you know, it's something that if you said 2 to 3, even 4 years from now, it will be having a major impact, positive impact on the economy on that kind of a time frame. It's a very long lead time before you saw any major big picture benefits to the U.S. economy, but could very well be one of those things that represents a turning point in the market as we get out to 2016 and 2017. Something to be bullish once we get out to that time frame.
Fair to say this is the rosiest picture we've seen in the oil and gas markets in a long time?
It is, and frankly, it's one of the brighter things that I see in the U.S. economy. Frankly, we think that the road that we'll have to hoe between now and 2016 is a pretty treacherous one in the asset markets. The U.S. economy, we would argue, is still on its back and is having a very difficult time recovering. There is, of course, the current discussion about jobs, and of course, we've thought jobs reports were off quite a bit. Now we know that they've been orchestrated lower, and by the BLS no less. So we do see some struggle and strain within the U.S. economy, but perhaps the reemergence of growth and a growth in the business cycle is something we could look forward to in that 2016 to 2017 timeframe.
Yeah, the U.S. economy like one of those MMA fighters fighting on its back, but fighting all the same. Now, oil price spikes, they've been common since turmoil spread across the Mideast and North Africa 3 years ago. And the U.S. and Europe have tightened sanctions on Iran. This is what we're going to talk about right now, trying to force the country to modify its nuclear program to exclude nuclear weapons. The Western sanctions on Iran have taken, and this is just an estimate here, about a million barrels of oil off the world markets each day. Now, if full resumption of Iranian exports does resume, and that could happen, some folks are saying, that could reduce the price of crude oil further by 9%, nearly $9 a barrel, although such development might be unlikely, depending on how you read into what we're hearing right now. But are these global hotspots that could flare at any moment, do you still see the potential for some of these price spikes?
We do see the potential for the price spikes, and clearly that is a geopolitically driven thing. And so those X factors are difficult to anticipate, but volatility in the oil market, that's as common as the day is long. What we would expect is, again, not only continued downside pressure because of additional supplies potentially coming from Iran, but we also have Iraq doing the same thing. Iraq is a very large OPEC contributor, and they don't necessarily get in line with Saudi when it comes to the Saudis increasing or decreasing supplies. Iraq would like to increase supplies and continue to do so. So we could see a market that is even oversupplied with oil. Now that would be great for the American consumer. That would be great for the global consumer, but would certainly press oil prices in that event where we have both Iranian and Iraqi oil coming to market probably below 65 on the barrel.
All right, so things look good, but anything can change, as we talked about with some of the geopolitical pressures that still exist out there. Let's turn and look at employment a little bit more. In the Federal Reserve, this never-ending easing program. A lot of folks are warning now about bubbles. We heard Kyle Icahn, talk about a potential drop in the market coming. And we also heard from David Stockman, the former White House budget director under President Reagan, talking about the potential for some bubbles here. We want to get your take. What do you think, David? The market's at all-times high here. That's normally not a good time to jump in. Do you see a bubble bursting here anytime soon?
Well, John, no one ever went broke taking gains, and I think that is prudent for any investor in these markets. That doesn't mean getting out of the market 100%, but it does mean paring back some of the positions that you may have in the stock market. Things that are concerning to us. First of all, volumes have been very low. We've got about 50% of the normal volumes, or the volumes that we had 5-6 years ago. We're down 50 to 60% off of those levels. The second point is that we have more people speculating in the stock market with someone else's money. We've got over $400 billion sitting in margin accounts today. That is, again, money that people don't have, but they've gone ahead and borrowed from their brokerage houses to increase what appears to be an absolute sure bet in terms of upside in the stock market. Another way of looking at that is you've got $400 billion of hot money that can come out of the market very quickly, and that's enough to precipitate a major decline. We've anticipated a 15 to 20% as a minimal move lower in the stock market, with as much as 40% being there if we begin to take out stop losses and really see a cascade effect in that market. The last thing is that we've seen insiders continue to sell aggressively into rising prices. So kind of a conflict, if you will. Insiders, that is the corporate executives who run these companies, they've taken their personal holdings and they've been selling them as quickly as possible. Meanwhile, they're taking company capital. They're taking company capital and buying back share prices in order to boost earnings per share, manipulate their numbers essentially to beat Wall Street expectations, and that delivers for them big fat bonuses while creating this sense that all is well in the economy and with these companies. Again, you're really talking about a way of manipulating perceptions, and I think that leaves us with real caution in terms of potential market downside.
And the kind of thing that really aggravates and just infuriates investors who know that type of stuff is going on, and it brings a lot of emotion into the markets as well. Now, Janet Yellen and the rest of the Federal Reserve, they've got to know that as soon as they hint at tapering the stimulus, it's going to cause a huge reaction and a negative one in that effect. How do you think, this is going to have to come to an end sooner or later? Is there any way they can soften that blow? Maybe do it slowly but surely? I mean, what's going to happen here?
Well, I think the issue is twofold. Number one, interest rates have to stay low. So the idea that they're going to move the Fed funds rate higher, that's a difficult one to accomplish. And we'll get to that in just a second. But the purchases, the $85 billion worth of mortgage-backed securities and treasury bills, bonds, and notes, they really can't stop that either. Look at this year as a perfect case in point. The fiscal year 2013, the White House estimated that the interest component on the national debt would be $250 billion. With the major, I should say minor, increase in interest rates, minor in the grand scheme, just in the months of May and June and July, that 250 billion was missed by 60%. The actual number when we closed out year 2013, which we have closed out the fiscal year, was $415 billion, and that's the interest component of the national debt. That was supposed to be 9% of total revenues, ended up being closer to 15% of total revenues, and that's with barely moving the needle in terms of interest rates. So our view is that, yes, certainly we need to see taper, but the bond market can't afford it, and fiscally, you're talking about suicide. You're talking about fiscal suicide to allow rates to rise. Their hand is really forced to continue the bond buying. And if they chose to do so, you could look at that one line item in the budget, interest component on the national debt, go from current 15% of our total revenue to close to 25% of our revenue, which, again, you're talking about game over. You're talking about our foreign creditors looking at that and saying, we're dealing with a bankruptcy situation here. Do we really want to own these assets? And that's where you could see a real cascade effect if foreigners saw, again, this line item increase and decided to start dumping treasuries and dollar assets in earnest.
Yeah, I wouldn't be the first one to use quantitative easing and comparing that to heroin and a drug addict, but that scenario you mentioned right there is really hammers that point home. So scary there. We'll have to keep an eye on what happens to that. As the average investor out there is kind of tuning into all this now, a lot of folks are looking at the stock market because we're flirting with 1,600. We've been back and forth now. What do you tell them regarding their asset allocation so that they can kind of prepare themselves for some of these, problematic situations that you just laid out for us?
Well, prices can certainly go higher, and that is the reality. People are playing the momentum to the upside. But do bear in mind, there's only 2 other years in the last 100 years of stock market history that have been more overvalued. And those would be 1999 and 1929. So you're now in the 3rd most overvalued market in U.S. stock market history. So if you want to play for the upside, just understand the risks inherent in the project that you're embarking on. That doesn't guarantee that we're going to see a precipitous decline like we had in 1999 or 1929, in which case you saw 50 to 90% declines in the stock market. It's not to say that we'll see those kinds of declines, but you are now in an area where you're playing the greater fool game on Wall Street, where you're assuming that someone is going to come in and pay an even higher price than you've paid. And that game works for a while, but momentum does ultimately run out of steam, and then the course has changed and you've got momentum on the downside as well. So I would say be very cautious in terms of an allocation. I would be increasing cash to 1/3 of your liquid assets. I would be adding to a precious metals position aggressively with prices at these low levels. Silver nearly 60% off its peak, gold about 30% off of its peak. These are value assets, while you've got overvalued assets in the paper market today. And certainly look at that cash component, 1/3 of your liquid assets, as a prized possession. If you think it's doing nothing for you, that's just fine. You need to be making that provision now before everyone else is, because I think the downside is going to shock many people.
And you want to have that cash so you can hop back on board when things do go off the rails.
Absolutely.
Now, we like to wrap up here, Dave, with you because you have a unique perspective and a lot of folks here out there. Are there any other economic indicators right now that stand out to you, good or bad, that you're not hearing other folks talk about out there?
Well, I do think that the Third Plenum Congress over in China, this is the Communist Party Congress, was very important for the direction of the U.S. Treasury market and the U.S. dollar in particular, because they are very detailed now, working towards emancipation from the old business model, which was an export-oriented business model. And, that export orientation meant that they were accumulating surplus dollars while we ran trade deficits. Those surplus dollars were recycled into treasuries and into U.S. dollar assets to avoid an increase in the value of their domestic currency. Now that they are in earnest pursuing a different business strategy, I think we have to assume that we're not going to see the same extent of dollar recycling, and thus we're losing one of the primary supports for the U.S. Treasury market and the U.S. dollar, even as we speak. So as we move into 2014 and 2015, this erosion of interest in treasuries and dollars, regardless of what the Treasury does and the Fed does to prop up these markets, we're losing one of the primary supports from the Chinese. And I think that is an absolute critical observation to make, an adjustment to make if you're long the bond market and assuming that the stock market and dollar assets are going to treat you as kindly as they have in the year 2013.
Yeah, big changes ahead for China, and the child policy changing, of course. Just think about the diapers and the baby food alone going into China that might be needed. David McAlvany, always great to see you. Thanks for joining us from Skype. A pleasure talking with you.
Anytime. Thank you, John.
And thank you for watching Money News on Newsmax TV.